discussing precious metals exchange traded funds. That's it, folks. The ones we're talking about are, of course, gold and platinum, the big ones. And now we're going to take a look at the way those instruments work and the opportunity that might lie in that space. Viv, so to summarize, before the break we said we're pretty constructive about the platinum outlook. We know that the mines themselves are in all sorts of trouble. It just seems to go from one quarter to the next. We know that Anglo Platinum is trying to work out what it should do about staff reduction. We know that Impala, we don't hear about much, but when we do, it's about their mines being stolen in Zimbabwe. The gold mines, it's almost worse. The results look okay up to a point, but there are always issues of grade, and there are always worries about whether they can afford their capital expenditure. And then we know that the commodity price has been plummeting. Why would people look at the exchange-traded notes versus the exchange-traded funds? Why do you like in particular? And tell me what your sense is right now, given what we've been talking about.
If you're a gold bull, if you're one of those guys that believes gold's going to go ballistic, the $8,000, $10,000 an ounce gold bull, you don't want to be in the mines, even then. The reason being is this: the mines, the costs are rising. So if they do have a huge increase in profits, you'll have some of that profits going towards labor, and a lot of it going towards government, because government's going to step in and take a windfall tax for that. You cannot envision gold going up, $8,000, $10,000 an ounce without government coming in and putting a massive tax on those profits. At the same time, if that does happen, if you do have that gold, bullish view, buying an ETF eliminates all those issues: governance issues, cost issues, strike issues. It just becomes, is your view on gold right or not? Why complicate it by trying to see, I'm right on gold and I'm right on the mine I'm picking?
Yeah. Okay, and your view, you said earlier, is that you've got to have a view on the rand. Understand your view on the rand is what?
Look, I think the rand is probably undervalued at the moment, considering some of the factors in play. But however, considering some of the risks that are coming into play over this next, say, 2 or 3 months, strike action, as I mentioned, as well as electricity, possible outages, the rand may weaken dramatically, and it's good to have a little hedge against it.
Okay, but I want to get to the heart of this thing. I mean, if you are a long equities investor, right, then you are presumably optimistic about the outlook for the economy globally, locally, in the sector that your stocks are in, and the companies themselves. So you're going to build a portfolio which is, optimistically oriented. If you're that kind of investor, is there any place for a kind of disaster scenario side bet in your portfolio?
It's always good to have a hedge against the world. A little hedge takes a little risk out of it, especially when you have this kind of hedge, because if the world does go great, platinum will perform. Maybe not as well as some of the stocks out there, but it will perform. But should we have a disaster, it will take some of the risk out of that disaster by giving you something that will perform well in the
Okay, but if conversely you are uber bearish and you think that this is all going to end in tears and that Bernanke's been blowing an enormous bubble, then you might have a large part of your portfolio invested in these kinds of units.
Yes.
And then if that was the case, what sort of time frame would you be looking at?
Look, I mean, if you have a scenario, like I mentioned before, of many, many years in which a metal outperforms a business, you have a very, very bad world outlook. If gold outperforms, say, the JSE for 10 years in a row, or for a 10-year period, that's an incredibly negative market environment, because you have a company that's producing something of value and you have a piece of metal that sits in a vault. And if the vault metal is more valuable than the company over that period, you have a really bad world scenario. You have to have an extremely negative outlook to have that as your
But there are people like that. We know there are people like that, and their alternatives are what? Either leave money in their accounts in cash, or look at something like this as a significant allocation, and then benefit, as you say, on both legs, the rand weakening potentially, and also the fear trade.
But also remember, these are ETFs. Absa is giving it to you, but not without a cost involved in it. They want to make money off this as well. It's about 0.4% a year. Over a 10-year period, that 4% may be something you want to consider. Maybe it's enough to make you justify going and buying the coin or the bar.
So just to clarify what you're saying there, you're saying Absa makes this all possible. They make sure that the spreads are nice and tight. They look after the gold over there. They have to pay Brinks or whoever it is in London that looks after the actual gold bars. So that's what they extract out of this, is 0.4%. But as these things go, that's not inexpensive. What I must just point out is that whilst ordinary shares pay dividends, have profits.
Yes.
This does not pay you anything.
Yes.
So that's another thing to get used to, is the idea that there's no opportunity here, there's no income, there's no rent check, there's no dividend every 6 months. This is effectively a pricing call.
Yeah, it's also a depreciating asset as well. You have actually effectively less gold at the end of 10 years than you had at the start because of the fact that Absa takes a bit of the value away.